Next, let me take you to Motheo Khwaripe. He is standing by with Moneyline Briefs and has a guest to unpack the rates decision. Motheo?
Definitely an unchanged decision. That was South African Reserve Bank has decided to keep interest rates unchanged at 6.5%, warning that further cuts are not on the cards in the foreseeable future. To unpack this decision, I'm joined now by Dr. Azar Jammine, Chief Economist at Economatrix. A decision that was expected by the market, but those comments right at the end by the Reserve Bank Governor that no more cuts.
There's no question that we can't have cuts, and I think it was quite obvious in light of the rise in the oil price and the fall in the rand in the last month or two that there's no way that he can cut interest rates at the moment.
When we look at his inflation forecast, at his growth forecast, and also the oil prices that are rising, what's the likelihood of the economic future for the South African consumer?
The outlook for the South African consumer is better than it was a couple of years ago because we're looking at an inflation rate that is still likely to be somewhat lower than we had feared. We're talking about 5%, 4.5%, 5% instead of the 6% and even the 7% that we had in 2016. And given that wage increases are not slowing down, in fact they're accelerating, consumers will still have enough to be able to carry on growing their spending at a reasonable rate. But it's certainly not boom times.
Not the greatest of times. I mean, when you look at the unemployment rate, still very high, and that fuel price that is likely to affect the petrol price locally at $80 per barrel, how is that going to play on pockets of consumers that are already under pressure?
Look, in the very short term, without a doubt, the increase in the rate of VAT and the hike in the fuel price, and we're looking for another increase in 2 weeks' time of about 90 cents a litre. That will weigh on people's ability to keep up with their spending. But don't forget, they went crazy in November last year on Black Friday. Retail sales in November grew by nearly 8% after inflation. Yeah. I mean, that says that consumers are not in such a bad shape after all.
Let's look at this case study then, the ones that are paying back debt in terms of that 10% prime lending rate, and those that have decided to save money. What's it likely to play out like for the rest of the year?
Unfortunately, for those who are trying to save money by leaving their money in the bank, you know, they're not going to get a very great return. For those who are borrowing and have debt and are paying 10%, it's also not that bad. I remember 10, 20 years ago when people were paying 20% interest. So yes, 10% is higher than the 9.5% that prevailed for a short period of time. But goodness me, it's the lowest rate of interest that borrowers have had to pay for the last 40 years.
And if I'm looking to save, how do I get that bang for my buck then?
If you're looking to save, the only way you can really do it properly is to make sure that you spend less than you earn.
All right, keeping within our means there, that was Dr. Azar Jammine, Chief Economist at Economatrix.